Political uncertainty adds fuel to the fire. Debt ceiling battles in Washington remind investors of the unpredictability of U.S. fiscal policy. Foreign buyers, particularly China, have reduced their Treasury holdings, with China's dropping from $1.3 trillion to $770 billion. Inflation expectations remain elevated. The 10-year break-even inflation rate derived from TIPS hovers around 2.5%, above the Fed's 2% target. This skepticism about the Fed's ability to control inflation is baked into the term premium. Supply-demand imbalances in treasuries exacerbate the issue. With $1.7 trillion annual deficits and the Fed no longer buying bonds, the market must absorb unprecedented issuance. When supply outstrips demand, prices fall and yields rise. The ripple effects are widespread. Mortgage rates have surged, with 30-year fixed rates hitting 8%, their highest level since 2000. About 0.75% of that increase comes directly from the higher term premium, adding $250 to the monthly payment on a $500,000 mortgage compared to 2021 levels. Pension funds and insurers, reliant on long-duration bonds, face capital shortfalls as bond values drop. Some insurers have been forced to sell assets to maintain regulatory ratios, creating a vicious cycle. Even the Fed acknowledges the term premium's impact. Minutes from their July 2023 meeting show officials discussing how its rise could tighten financial conditions, complicating policy decisions. Meanwhile, the dollar strengthens as higher yields attract global capital, creating stress for emerging markets with dollar-denominated debt, like Egypt and Pakistan. The term premium may be an obscure metric, but its effects are anything but. The Fed's impossible choice. The Federal Reserve faces a no-win situation that didn't exist in previous economic cycles. With U.S. debt now at 120% of GDP compared to 65% during the 1994 rate hikes, every policy move carries dangerous side effects. Raise rates too much, and the risk of a debt crisis looms. Cut rates too soon, and inflation could spiral out of control. There's no painless way out. In 1994, the Fed could aggressively hike rates 7 times because debt levels were manageable. Today, a 1 percentage point increase would add $370 billion in annual interest payments, money that could otherwise fuel economic growth. The Congressional Budget Office projects interest payments will consume 3.5% of GDP by 2033, more than double the 50-year average. This starkly limits the Fed's flexibility compared to past cycles. Vanguard's research suggests the neutral rate, where policy neither stimulates nor restricts growth, has permanently risen to around 3%, up from 2% pre-pandemic. This means rates won't return to the near-zero levels investors grew accustomed to, even when the Fed stops hiking. Both stocks and bonds face continued pressure in this environment. The Fed's traditional playbook no longer works. In past crises, they could slash rates by 5 to 6 percentage points to stimulate growth. With rates currently at 5.25%, they have only half that room before hitting zero. Quantitative easing also faces limits, with the Fed's balance sheet still above $7 trillion. Their policy tools are far less potent than in 2008. Corporate debt adds another layer of vulnerability. Over 40% of investment-grade bonds mature in the next 5 years, requiring refinancing at higher rates. Aggressive hikes could trigger a wave of defaults, but keeping rates too low risks reigniting inflation, which remains above the Fed's 2% target. Core PCE, their preferred measure, is stuck at 2.8%. The labor market complicates things further. Unemployment sits at just 3.9%, suggesting the economy can handle higher rates. However, job openings have fallen 30% from their peak, signaling potential weakness ahead. The Fed must decide whether to prioritize current strong employment data or the warning signs of a slowdown. Global factors further constrain the Federal. Other central banks face similar dilemmas, creating coordination challenges. The ECB recently paused hikes despite inflation above 5%, fearing recession. If the Fed stays hawkish while others pivot, a stronger dollar could hurt U.S. exporters and emerging markets with dollar-denominated debt. Banking sector stress highlights the system's fragility. The 2023 regional bank collapses showed how higher rates can cause unexpected failures. Over $500 billion in unrealized bond losses remain on bank balance sheets. Another rate hike could trigger more failures, while cuts might signal panic. Fiscal policy adds to the challenge. Despite higher rates, Congress continues running $1.7 trillion deficits, undermining the Fed's tightening efforts. Inflation expectations have also become unanchored, with consumers expecting 3% inflation long-term, according to the University of Michigan survey. Once embedded, these expectations are hard to reverse without causing a recession. The housing market underscores the Fed's dilemma. Mortgage rates near 8% have frozen the market, with existing home sales at 13-year lows. Yet, home prices remain elevated due to tight inventory. The Fed faces pressure to help buyers, but risks reigniting a housing bubble. With so many conflicting pressures, the coming Treasury market earthquake. The U.S. Treasury needs to sell $1.7 trillion in new bonds this year, an amount larger than the entire GDP of Russia. But here's the problem. The usual buyers are pulling back. China's holdings of U.S. debt have dropped to $770 billion from a peak of $1.3 trillion. Japan, once our biggest foreign creditor, is cutting back too. Meanwhile, the Federal Reserve is letting $60 billion in bonds roll off its balance sheet every month without replacing them. This leaves regular investors to absorb a tidal wave of new debt, threatening to overwhelm the market like a small boat in a storm. Recent Treasury auctions highlight the strain. Participation has hit record lows, forcing primary dealers, banks required to buy unsold bonds, to take on much larger shares. For example, in November 2023, they absorbed 18% of a 7-year note auction, double their usual share. The bid-to-cover ratio, a key measure of demand, fell to its weakest level since 2016. When demand falters, yields rise to attract buyers, which spells trouble for existing bondholders. This supply-demand imbalance could have serious consequences. JP Morgan analysts warn it might trigger another repo market crisis, like the one in 2019 when a sudden cash shortage caused overnight lending rates to spike to 10%. Back then, the Fed intervened with emergency measures. But today, the stakes are higher. Treasury borrowing needs have surged 80% since 2019. The math is daunting. The U.S. government must refinance $7.6 trillion in maturing debt this year alone. Imagine trying to pay off your mortgage by taking out a new one at double the interest rate. Each refinancing locks in higher costs for decades. The average interest rate on U.S. debt has already doubled from 1.6% to 3.2% in just 3 years. Foreign demand isn't coming back anytime soon. China is selling treasuries to prop up its currency and reduce exposure to U.S. assets. Japan's life insurers, once major buyers of long-term treasuries, are shifting to domestic bonds as Japanese yields rise. Together, these two countries used to buy 40% of treasury issuance. Now they're net sellers. The Fed's quantitative tightening removes another major buyer. From 2020 to 2022, the Fed purchased 60% of all new treasury issuance. Now they're shrinking their holdings by $60 billion per month, leaving a gaping hole in demand. Banks aren't stepping in either. After the 2023 regional banking crisis, regulators are requiring banks to hold more capital against their treasury holdings, making bonds less attractive. Commercial bank holdings of treasuries have dropped 15% from their peak. Retail investors, through mutual funds and ETFs, have become the buyers of last resort. But even this has limits. Bond funds saw $200 billion in outflows during 2022's market rout, and many individual investors remain wary. The iShares 20-plus year Treasury Bond ETF, TLT, for instance, has seen its assets shrink by 30% since 2020. The auction calendar is relentless. Quarterly refunding auctions now sell $120 billion in notes and bonds at once, testing the market's capacity to absorb debt. Long-dated bonds face particular pressure, with weak demand pushing yields higher and steepening the yield curve. The Treasury projects needing to issue $23 trillion in new debt over the next decade. That assumes no recessions, no new spending, and no further rate hikes, assumptions that seem increasingly fragile. For investors, the question is clear. How much more strain can the market take? The hidden $158 trillion liability. When we talk about the $37 trillion national debt, we're only seeing part of the picture. The real number is actually $158 trillion when you count all the unfunded promises for for Social Security and Medicare. These programs have $121 trillion in liabilities that don't show up on the official balance sheet. That's like owing more than 2 houses worth of debt per taxpayer, considering the median home price is about $400,000. Social Security's trust fund will run out of money by 2033 if nothing changes. When that happens, benefits automatically get cut by 23%. For the average retiree, that means losing about $500 from their monthly check. Imagine a retired couple who relies on Social Security to cover rent and groceries. A $500 cut could mean choosing between paying for medication or keeping the lights on. Medicare's hospital insurance fund faces insolvency by 2031. These aren't distant problems, they're coming within the next decade. The math behind these programs is simple but alarming. There are currently 2.7 workers paying into Social Security for every retiree collecting benefits. By 2035, that drops to just 2.3 workers. People are living longer and having fewer kids, which means fewer workers to support more retirees. The system was designed in 1935 when life expectancy was 61. Today it's 79. Medicare's problems are even bigger. Healthcare costs keep rising faster than inflation. A 65-year-old couple retiring today will need $315,000 just to cover medical expenses in retirement, up from $245,000 a decade ago. With 10,000 baby boomers hitting 65 every day, these costs are exploding. Politicians have known about this crisis for decades. The last major Social Security reform happened in 1983, when they raised the retirement age to 67 and increased payroll taxes. But they didn't fix the underlying math problem. Now, gradual fixes are no longer an option. The Congressional Budget Office projects that by 2052, spending on Social Security and Medicare will consume 14% of GDP, more than the entire federal budget today. Add in interest payments on the debt, and we're looking at 20% of GDP just for these obligations. That leaves almost nothing for defense, education, or infrastructure. State and local pensions add another layer to the problem. Truth in Accounting estimates these plans are underfunded by $1.5 trillion. Cities like Chicago and states like Illinois have pension funding ratios below 50%. When these plans run short, they either cut benefits or demand higher taxes, both bad options.